Before we can start creating transactions in Wave, we'll need to first set up your sales tax rates. Now, not every business needs to collect sales tax. It really depends on the types of products and services you're providing and the states that you're providing them in. To determine whether or not your business needs to collect sales tax, I would highly recommend that you speak with a certified public accountant in your area or talk with your state's tax department. Once you've determined that you'll need to collect sales tax, let's show you how to set that up inside of Wave. As with most settings in Wave, you'll begin by going to the gear icon that's in the upper right of the main page. Click on the gear and select Sales Taxes. As you can see, I don't have any sales tax rates set up yet for this company. So to set up a new one, I can click Add a Sales Tax. We'll first want to start by giving the sales tax a name. Usually this name is related to whatever entity is requiring us to collect those taxes. So I will call this one my state tax. Now obviously you won't want to call yours state tax because you might have taxes in multiple states. So you might call it Utah tax or Texas tax or California tax. But I'm just going to call mine state tax to keep it general for today's presentation. You'll need an abbreviation. This abbreviation is what's going to show up on your invoices to tell you which taxes you're using for that particular transaction. And then you can leave a more detailed description here if you would like. And that's just for your records here in the settings. Your tax number should be the tax number that you've used to register with this particular entity. Every entity you register for sales tax will give you a number that you use to report those sales taxes back to them every month or quarter, as the case may be. Now, the next settings section is extremely important. The items that we've just put in can be changed to some extent, but the checkboxes below are fixed once we save this tax rate. And the only way to fix it would be to delete the tax rate and recreate it. So we want to be very careful about how we select the checkboxes below. First of all, you can show whether or not the tax number shows up on invoices. Some jurisdictions require that. Here in the United States, most jurisdictions do not. So I'm not going to click that box. The other ones are extremely important. Is this tax recoverable? And is this a compound tax? Since recoverable and compound taxes are options that are permanent, I want to make sure that you understand what those two terms mean so that you can set up your sales tax right from the beginning. First, let's look at the recoverable tax. A recoverable sales tax means that the taxes that are owed are reduced by the amount of the taxes that are paid. Let's look at an example. So in this example, let's say that I make a sale of $100 worth of taxable goods. My tax rate is 5%. So I would collect a sales tax from that customer for $5. Now, let's say that I buy supplies for $20 and I end up paying a sales tax for those products, which would be a sales tax of $1. So now I've collected $5 and I've paid $1. If my tax was a recoverable tax, that means that I can take the $5, subtract the $1, and I would only be required to submit to that tax entity $4, because one of those dollars was recoverable. Now, if my tax was not recoverable, I would have collected the $5, and even though I've paid $1 in taxes, I'm still required to submit the entire $5 worth of sales tax to that tax agency. So it's important for you to understand whether or not your sales tax is recoverable, because if you mark that, Wave will help track for you the amount that you can recover so that you pay only the amount that's required back to that tax agency. Now let's look at a compound tax. A compound tax is a secondary tax that is charged after a primary tax. And it charges the tax percentage on the total amount of the sale and the taxes that were collected previously, hence its name a compound tax. It's probably better to explain through an example. In the United States, a compound tax is not extremely common, but it is in Canada. A good example of a compound tax would be Canada's PST, as compared to a GST. So let's see how this would work. Let's say that we have a $100 sale, and our GST is a 5% tax rate. So, just like in the United States, we would take our $100, times it by our 5% tax rate, giving us a sale total of $105 that would be due from the customer. But with a compound tax, we're not done yet. Let's take our PST, or our compound tax, and add it in. For this, we would take the total amount of the sale, including our tax to this point, which would be $105. Then when we would times that by our tax rate, let's say 10%, giving us $10.50 of additional tax. We would add that onto the total sale, giving us a total of $115.50, which would then be due from the customer. So as you can see, with a compound tax, we're not just taxing the sale itself, but we're also taxing any previous taxes that have been levied against that sale. Hopefully that helps you understand a little bit about what a compound tax is and what a recoverable tax is. As I said, compound is not as common in the United States. Recoverable sometimes can be, but it's important that you understand how the rules work for your particular sales tax. And sales tax rules in the United States can vary from municipality to municipality and from state to state. So I highly advise that you seek advice from your state or local tax agency and a qualified CPA that can help you understand how tax laws work in your area and ensure that your taxes are set up correctly so that you're collecting sales tax according to the laws in your area. So now that you better understand what a recoverable and a compound tax is, go ahead and check those if they apply. In this case, they're not going to apply to either one, so I'm not going to check either one. And then we'll need to put in our tax rate. Your tax rate you should receive from the entity that's asking you to collect those taxes when you register. So they'll let you know what rate you're supposed to use. If you're not sure what that rate is, you need to contact that tax entity and ask them to look up your rate for you so that you know what rate you're supposed to put in. I'm just going to put in a rate here and save. And now I have my first tax rate set up. Now in some states, like Utah, there is one tax rate that's issued by the state that includes all of your local municipalities, and you simply pay all of them as a flat rate to the state, and then the state redistributes out to the counties and cities and local areas for you so that you don't have to worry about collecting from multiple entities. However, in other states, you need to collect from both the state and the local municipalities, and then issue tax payments out to each of them individually, which means that very often when you're collecting tax from multiple entities at the same time. If that's the case in your area, you'll want to make sure that you set up a separate sales tax item for each municipality that you're having to register with. So let's go ahead and set up a local tax. Because we'll use that when we start talking about invoices, and I'll show you how you can add multiple taxes to one invoice if that's the case for your particular state or area that you're located in. So now we have our tax rates set up so that we can use those as we begin to purchase and sell items inside of our business here in Wave. Thank you for watching the Bootstrapper's Guide to Wave Accounting. If you found this video useful, I encourage you to click the like button below, subscribe to our YouTube channel, and share this video with other entrepreneurs. Doing so will help us to continue creating more videos like this one for you and other Wave users here on the Accounting Lab.